Welcome to the WangHiro podcast, where we answer Malaysians' burning questions about personal finance with fact-based answers.
How did a yoga brand grow into an athleisure brand valued today at over $50 billion? Chip Wilson founded Lululemon in 1998 with the $800,000 he received after selling his first brand, Westbeach, in 1997. Fast forward now, almost 3 decades later, Lululemon is a huge athleisure brand competing with big boys like Nike and Adidas. Its share price is worth over $400 at the time of recording. Today we're asking, is Lululemon worth investing in? Welcome back to Stock Investing from Zero on WangHiro, a series where we put a beginner's lens on companies to help you decide if you should invest. We do this by asking 4 questions. What do they do and how do they make money? Number 2, are they profitable and financially stable doing it? Who is their audience and how big can they grow? And finally, are they cheap or expensive? So John, let's start with the first question. What does Lululemon do?
They actually make yoga pants. Long to short, they make yoga pants. And what's interesting is from that single focus on yoga pants, they've actually branched out to tops, hair accessories, jackets, undergarments, bag, yoga mats. And what's interesting is you would think that yoga pants is only for ladies, right? Their men's revenue segmentation is coming close to $1 billion. That means, yeah, it's quite insane. It's 900 over million.
Wow.
You would imagine that it only appeals to women, but now they're really seeing a rise in like even men actually taking up. So what makes their pants so special? They trademarked this particular fabric called Luon, L-U-O-N. Okay, it's the amount of nylon microfiber is higher than your average, and I think that's why it makes that kind of quality. They're not cheap. It's about $99 per pants USD. So if you convert back here to Malaysia, it's probably close to 500 ringgit for a pair of pants, you know. So you can buy probably 3 or 4 Levi's jeans, right, with 1 yoga pants, right? And I think it's not for your normal, what do you call it, normal consumer. It does appeal a little bit more to the upper end of the market. And I think now with all their range of products, deodorant, you know, even dry shampoo.
Oh.
Yeah.
Wow, they're literally in everything. I thought it was just apparel like jackets, pants.
Yeah. And now they bought over this company. They bought over this company in before COVID, called Mirror, which is actually a company that it's actually a screen or an app that actually tells you about your lifestyle and exercise. They wrote down that investment because of COVID. Apparently, it didn't really take off. But what it goes to show me is this: when they do realize a mistake of an acquisition, they do actually close and move very fast. And it didn't really hit their top line that badly or their profit that badly. So, in short, it's a health, athleisure, lifestyle company rather than just selling yoga pants. I think they're trying to be that. You see?
And also to that point about like them having their own like fabric, some people also call it a fashion technology brand.
Yes, that's right. That's right. Because there's one other company. It's not yet public, but I really admire the founder, Sarah Blakely. It's called Spanx. Spanx.
Yes,
yeah,
Spanx.
Yes, Spanx. So she created, something that she wanted to have herself, and she went door to door in a car, peddling all this product. One day, if it's listed, I would love to feature them.
I'll be first to cover them for sure.
Yeah. And I think having your own technology, like Under Armour, will be interesting to cover Under Armour. So they just had a new CEO, lady CEO, ex-Marriott Group. The technology of the fabric itself, it's really the game changer from my point of view, because rather than just having, you see Nike, Adidas and all that, they were actually one of the pioneers, the few pioneers that actually developed sports technology into where it is today. And I think if you do not own that technology yourself or to develop your own IP, I think just being a marketing company is going to be very, very tough going forward. When you have all these big giants, Essex, Nike, everyone, sports technology, they spend billions in R&D, just to make their shoes. Like, if you've seen the Nike Vaporfly, I don't know if you heard of this shoe, Louis. One pair. You want to guess? Vaporfly. You know how much it costs? One pair of running shoes.
800 ringgit.
1,003, 1,006.
Oh, running shoes. I mean, back then I thought like something like 300 to 400 is expensive, but now it's really gone up.
Yeah, and it's banned from a marathon competition because the technology is so advanced. They literally shave off a few seconds off a marathon runner's shoe, a marathon runner's time. So they actually ban it because the technology is space age foam that actually gives you a bounce, an extra bounce. So they actually ban it. They actually ban it lah. Yeah, so is that crazy, Louis? So
that's crazy. That's
back
crazy.
to my point about what do they do? You need to own, they do yoga pants, but you need to own an IP instead of just the marketing.
Makes sense.
So second question, are they profitable, financially stable? Revenues is growing still close to 30% a year in a high US inflationary environment. You just imagine, people are right. The US government is raising interest rates because there's a high inflationary environment, and yet they still grew revenue close to 30%. Just to give you a benchmark, Nike grew only by about 10%. I did some some benchmark. Obviously, Nike is much larger than they are.
Correct.
Right, but at the same time, it's still quite insane, right? So I'm going to share my screen now to show you the numbers, and just to give you a feel about what kind of growth a company of this size can do for you, lah. So I'll plot out numbers from 2017. So this is their revenue numbers. High gross margins. Remember gross margin? Okay, so let's see whether you remember what I shared. Gross margin. What does gross margin actually tell you about a company's business?
Okay, I should know this. Okay, it's growing lah.
Pricing power.
Oh, okay.
Yeah. So when you have a company that has high price gross margins, that means you actually have pricing power that you can, because your cost of goods will determine how much margins you make in gross. But as your cost of goods get higher and higher, if you cannot pass on the price or the cost over to your consumer, your margins will get squeezed. But if you have continuous gross margin, if its growth is even more crazy, that means your cost remains the same, but you're passing on the price over to the consumer, and the consumer is still buying, and you don't do insane amounts of cheap sale. That means, that you have that pricing power. Okay. So I'm going to plot that. I'm going to plot net income. And I'm going to plot operating cash flow. So as you can see, it's quite insane now, right? Margins continue to increase. Profits continue to increase. And in a bad year, even in COVID, right, I think people were exercising more. There's one company that wanted to bang on the at-home exercise, Peloton. It failed badly. But look at Lululemon, it's quite insane now. So it goes to show you the kind of depth they had in their business acumen and to understand the product they're selling. Okay, so definitely financially stable. I think it's almost net cash. Let me look at the. Okay, so yeah, it was net cash until just most recently. So when you see net debt and it's negative, that means they're in a net cash position. But they must have bought something quite recently to put them into some sort of a net debt position. But it's very small, like 86 million comparatively to the cash they have, right? 1.1 billion. Their total debt is about 1.19, so almost negligible. They must have done some acquisition, and we need to dig into the numbers more deeply. But yeah.
Okay, so like it's all very positive. What I feel is quite interesting is they're like competing directly with brands like Nike, Adidas. They're still growing, right?
Correct.
So much room to go, like 30% at the moment, and then like to go from 30% to Nike's 10% is so much runway, I feel.
Precisely, yeah. And even you see when you under ticker, right, you see that the way that they even overlap, they consider, some of their analysts actually consider even expensive brands like fashion brands like Louis Vuitton and Hermes as part. I don't think so. But you see, I think this is where, Ticker, what one good thing about Ticker is that it takes a lot of analyst data especially in terms of the financial modeling, and they pump it in. And this is what what the street sometimes compare them to, lah.
Louis Vuitton.
Fashion, yeah. So you got Puma here, you've got Nike, you've got Anta Sports. I think I saw Li-Ning. Yeah, okay, yeah, Li-Ning. This is a Chinese company.
That makes sense, yeah.
Yeah, but I don't think in terms of the space Li-Ning is in versus Lululemon. Lululemon is very much into yoga, and Li-Ning is more badminton, more other sports.
And Lululemon, I think the athleisure component of it is quite strong compared to Li-Ning. Li-Ning is very, very sports. I don't think people are wearing Li-Ning out for fun.
Yeah, definitely not.
Yeah.
Definitely not.
Yeah.
So who is the audience and how big can they grow? In terms of their total addressable market, I think the athleisure market right now, a report from Allied Market Research is saying that between 2023 to 2032, you're talking about a market size of reaching 3.2 billion by 2032. So they expect the CAGR growth rate to be roughly about 5.2%. So there is a growing space. It's still very low base because 3.2 billion comparatively, just to give you context, semicon sales 1 year is about $500 billion. It's about 480 billion today. Okay. Obviously, that's a huge, right? You talk about everything from your car electronics to your computers to everything. So it's a very big, much a bigger market. But athleisure alone being quite niche, it's already the size of 3.2 billion. Yeah. Yeah. Going to be the size of 3.2 billion in 2032.
And probably seeing how Lululemon is expanding, probably they might go outside of athleisure as well.
Yeah. Probably there is a very adjacent space that they can go into, things like fast fashion. But again, when you go into fast fashion, then you're competing with the likes of Zara or Inditex, the likes of fast retailing, which owns Uniqlo, H&M, and all that. I think that's where I feel is a little bit more commoditized. They may not want to go there because it's very what do you call it? Fast fashion. It's like literally you're changing every season, whatever. More commoditized space. You throw prices to get rid of your inventory to move on to the next. Whereas an athleisure kind of like, let's say a Lululemon yoga pants, I don't think it changes that frequently in terms of design whatsoever. And I think that gives it a little bit more of a premium niche kind of pricing power comparatively to fast fashion. And they may not want to, but we'll see. Who knows? They have another subsidiary.
Yeah.
That alone just concentrates on fast fashion, you see.
That would be interesting to see. Yeah.
Yeah. So last question would be whether they are cheap or expensive in terms of valuation. As you guys know, we normally just have a quick look at their price to earnings ratio, and we plot a band rather than go into a mind-boggling DCF or a reverse DCF, just to keep things simple. If I drag for a 10-year period, okay, this is next 12 months, the forward, and last 12 months, which is the trailing. If you can see, let's take 10 years lah. You can see that the band is anywhere between highs of 82 and lows of about 20 times. So today they're going for about 50 times in terms of trailing, and forward probably about 30 times. So yeah, it's somewhere in between the band, but for an athleisure company, 30 times. Just to give you context, Google is, I think just not too long ago, was only about 20 times, So this is like a juggernaut. So again, you should be comparing them peer to peer rather than someone outside the industry. But I just wanted to give the audience context. Google can sometimes sell to you at 20 times. This is selling to you roughly about 32 times today for trailing, and then 45 times for forward. So I think when was the cheapest point? 9 times. Okay, 9 times was probably when they first listed, I think. 2008 financial crisis, 2009 financial crisis. So yeah, you gotta wait for another COVID or equivalent.
How about during COVID? How much did they? How
during COVID, they were selling for about not cheap also, 29 times, 30 times. Yeah, so it wasn't cheap as well. Yeah. So I think This was because they got listed in 2007. So I guess when you're young and you don't have that kind of track record, I think people plummet your shares much faster back then. But now knowing the resiliency of their income and the growth that they're having, right? I think people are more willing to pay for that kind of premium.
Okay, so like, should we wait for it to hit a 20 before we buy? It's not gonna happen. It looks
That
like.
all really depends on the risk appetite. I mean, like if you're growing, you see the way I look at PE is this. I'll just do a quick off the head calculation. Then you guys will see where I'm coming from. So I always follow the rule of 72. Okay, rule of 72 means that whatever compound rate of return, that number will give you you divide by 72. You will get the number of years it takes to double your money. So if Lululemon continuously grows at 50% every year, sales, let's assume, so 72 divided by 50, you're talking about 1 point something, 1.8 something, right? So that means for every 1.8 years, okay, let me get the calculator out, 1.4, okay? So that means every 1.4 years, you are halving your PE. Because let's say PE today is at 40, right?
Okay.
40, yeah. That means in 1.4 years or 1.5 years from now, your revenue would have doubled. Because 50%, ma? You get what I mean? That means every 1.5 years, your PE will become half. Your earnings will become half. Assuming everything else is the same, if you're earning, not revenue, let's say your earnings is growing at 50% every year. That means every 1.4 year, it becomes half. So what is 40 today is going to be 20 in 1.4 years. And what if it doubles again in another 1.5 years? That means in 3 years, your PE would have been a quarter of where it is. You see what I mean? So that's why sometimes we look at forward, because when you look at forward and the trajectory is true, that means the company continues to deliver that kind of growth. What looks expensive today will not be that expensive. But obviously, you're taking a risk. You're making an assumption that they can grow at that kind of rate. So where is your margin of safety? That's where it comes into play again.
Okay, interesting. So I think also like maybe there are some like price markups, because recently Lululemon went into the S&P 500. They're included because of the higher market cap. Is there like is there something we should be concerned about?
Yes and no. Yes, in the sense that now they are in the S&P 500. What happens is this. ETFs will start buying because they're already part of an index.
Right.
Right. So your IVV, your SPYs, your Vanguards will start buying all this kind of thing. And if they fluctuate in and out of the S&P 500, let's just say 1 year they drop market cap and then they come out again, the fluctuations of your share price will be even more volatile. Because the moment money is being pulled out, it's going to be in the droves. Because once you drop out of the S&P 500 components, right, all your ETFs will start selling,
Whoa.
Okay.
Is that likely to happen though?
I've seen it happen in Malaysia when stocks actually come in and out of the FBM KLCI and also come in and out of the Sharia index list. And it can be quite brutal when they do the rebalancing. Yeah. Especially the size of the market is big. Like, can you imagine like BlackRock today? I remember the last data point I had was 2018. The assets under management is 5.4 trillion, So you just imagine how much money they can move in a day just because of ETF buying and selling.
So should we wait as like investors? Should we wait, because they just entered the S&P 500? Is it like risky for us to invest now because of that reason alone?
I don't want to answer you with a direct yes or no, because everyone's risk appetite is different. Okay, everyone's risk appetite is different. Some people, they feel that at the trajectory and the growth rate that they're having, regardless of whether they're in the S&P 500, I like this kind of thing, and I think the margin of safety is sufficient. Some people will give all sorts of reasons to say wait for a crash to happen, whatever, but then the whole broad market will crash. So if you're in a portfolio where like 99% or 100% of your money is already invested, then for you that's where the rebalancing to buy into Lululemon or the cheap may be more beneficial for you. So everyone's what do you call it? Everyone's scenario is different. That's why I never give a yes or no answer, because it depends.
Right.
It really depends on your individual scenario, your individual investing style. You see, some people may say, "Wow, if like Nvidia never dropped below 20 PE." So if you're always looking at it 40 times is expensive, you'll never buy Nvidia. Like there's another company that they do EDA software, never drop below 40. So, yeah. So again, it really boils down to your understanding of the business and your risk appetite.
Okay, got it. Okay, so could not be a consideration depending on what you think. Okay, so I think that wraps up the Lululemon analysis for today. So guys, what do you think of John's analysis? Leave your comments in leave your comments below. All right, so now let's go to the last section of the podcast, which is the investing book recommendation. So every time we do stock investing from zero, we try to recommend a book to new investors out there. So what's the book today, John?
Today is going to be a business book, and I think the fallacy that a lot of people only read investing books to be a better investor is actually not true. I think the better way to learn, ironically, is but not just me, Buffett and a lot of successful investors actually talk about this. It's actually Estee Lauder. So I don't know if you heard of Estee Lauder. They're quite famous for their makeup, their cosmetics. I think the word I'm looking for is cosmetics, right? So if you were to look at Estee Lauder, they actually did a lot of what do you call it? They did a lot of innovation within the cosmetics industry. For example, what was the shape of your lipstick when you put out lipstick? What's the typical lipstick shape?
It's like a sharp tip. Yeah.
It's a sharp tip, right? Both sides, right? Like a pencil, right?
Yeah.
Do you know Estee Lauder was the one that came out with the tip that they shave it off, where there's a flat? It's actually their innovation. It's the Sun's innovation.
Interesting. I didn't know
Interesting,
that.
right? Yeah. So the book that actually there's a few books on Estee Lauder, but this is the one I'm trying to recommend to you. Beautiful Life. Yeah, this one. Which is this one. Okay. There are many versions of the book. There's one that actually denounces her. I can't remember. Yeah, there's one book that denounces her. It was an unofficial biography. So she wrote this book to counter that. And obviously, you would want to listen to both sides of the story so you can get both books is the best. But why I picked this one was because it was written and curated by her granddaughters. Yeah, so they give her a perspective of the lens of the granddaughters towards her. Obviously, it will be more biased to say it's favorable, but what I liked about it was because she talked about her relationship with the notable people like Princess Grace of Monaco, Hubert de Givenchy, Diana, and all that. And more importantly, what was the qualities that embody her to carry this brand all the way to its success today. It's not easy, I mean, you're thinking about, for someone in the 40s and the 50s, a woman, to be in the industry. There was one episode of a podcast where I listened where she was literally not begging. She had some dignity, but actually she was trying to get her product on Saks Fifth Avenue, which is like the highest end Parkson that they had in the US back then. And she was always rejected, but she created an ingenious way to market her product. I won't spoil the surprise. That's why go read the book. And that night itself, the purchasing manager actually called her and said, I don't know how you did it, but yeah, you have a shelf space in Saks Fifth Avenue, for Estee Lauder products.
I think a lot of young people may have seen this brand. I know that it was very popular in the 90s. Back then, my mom used to buy a lot of Estee Lauder products, but now less so. I think it has become less. The name itself hasn't been so prominent nowadays. So
Correct.
Yeah, so it'll be interesting to learn from Estee's life and
Yeah, and yeah, how she grew it into the billion-dollar company size that it is today. Is listed. Obviously, there's some generations of the family still in the business, but you see, one thing I like about reading biographies or business books is because they give you some sort of inside glimpse into an industry and a lot of nuances that you never know. And to be a better investor, it's always those nuances that actually gives you an edge, that information asymmetry. So there are many other books that I can recommend for business, like Bob Iger, right? One of the books that I recommended in the previous episode, Rat of a Lifetime. I would have never known the creative industry from that light if it wasn't for Bob Iger's book, you see. And because of that, I understand Fox News, I understand all these other channels, media companies much better. And when I go into investing, like, for example, there's a media company that just bought over the rights for F1. So they're Liberty Media. So that will be a very interesting company to study because they turn around F1. They created the hype for it today, because of the Netflix series, and more younger people are watching F1 instead of just the car enthusiasts, you see. So again, it's understanding that industry really well to help you better your investment strategies.
That makes sense. So I think we have to balance like reading these business books, and in the end, when we invest, we're investing in companies and businesses.
Precisely.
Understand these industries. So I think that's a great recommendation, John.
Yeah.
Hopefully I can have time to read it too. All right. So guys, that wraps up today's episode of Stock Investing from Zero. So over to you. Are you an investor of Lululemon? What is your outlook on the stock? Leave your comments below. If you enjoyed today's video, make sure to give us a like, subscribe, and hit the notifications bell for more updates from us. Thank you for tuning in today, and we hope to see you again in our next episode. Bye-bye.